I wanted to say a special thank you to the Minnesota community, which tends to be there when you need them the most. And so I wanted to say that I'm very, very thankful. So this is joint work with Martin, who is sitting in the back, and a Stanford grad student. So in the standard New Keynesian model, the central bank controls the short rate, and that's the short rate in the household discount factor. And the short rate is the return on savings and investments, and so the central bank turns out to be very powerful. In this paper, we're going to study a New Keynesian model with a banking sector. There, the central bank controls the interest rate on Fed funds, so this is interbank borrowing and lending, or the interest rate on reserves. Households don't hold these assets directly. Instead, they're held by banks that hold these assets to back inside money. That's going to create a disconnect between the policy rate of the central bank and the short rate that belongs to the household discount factor. And that's going to affect transmission of policy and how the model works. The central bank here chooses the reserve supply, and it can do that in two ways. One is to choose a very large reserve supply. That's the system of, let me first start with a small reserve supply, a system where reserves are scarce. That's the corridor system that we had before the financial crisis. There, the policy was targeting the Fed funds rate. That's the rate on interbank borrowing and lending. It was fixing the reserve rate. And was adjusting reserves to just implement the target Fed funds rate. So that was the system with scarce reserves. Now we live in a system with abundant reserves. So the Fed chose to increase the reserve supply to a point where all it's doing really, it's targeting the reserve rate, and this is the so-called floor system that we're currently in. And this distinction is going to matter for the transmission of monetary policy. Let me just spend a few slides more on this distinction between these two regimes. So here is the banking system with scarce reserves that we had before the financial crisis, the corridor system. So there, the Fed was choosing a level of reserves, the quantity of reserves, to be small enough so that we were still in a region of reserve demands for banks where reserve demand was interest rate sensitive. We were hitting the downward sloping part of reserve demand for banks. And so it was trying to target the Fed funds rate, the interest on interbank borrowing and lending, which was above the interest rate on reserves, which at the time was 0. And so now you can imagine what happens if the Fed tightens policy, so it increases the Fed funds rate. What happens is that, so you do so by shrinking the reserve supply, so you adjust the reserve supply to increase the Fed funds rate. And so what happens is that the spread between the Fed funds rate and the rate on reserves increases, and that increases the cost of liquidity for banks. So tightening in the corridor system increases the cost of liquidity for banks. If you think about monetary policy now, in the current system where the reserve supply is so large that we're in the interest-insensitive part of the demand function for reserves by banks, now what the Fed is doing, it's increasing the rate on reserves, but the rate on reserves is basically equal to the rate on Fed funds, so those two rates are the same. And so what happens is now tightening of policy is no longer affecting the cost of liquidity for banks. The cost of liquidity for banks is just, it doesn't move because these two rates are the same. So monetary policy is going to be transmitted in very different ways across these two regimes. And so this is going to affect the transmission mechanism, and this is what I'm going to talk about, together with the fact that households don't really hold these assets directly, the disconnect, that's going to affect transmission. So in the standard New Keynesian model, interest rate is all what you care about. That's all that matters. The plumbing of the financial system and quantities don't really matter. In the New Keynesian model with banks, there's a disconnect between the policy rate and the short rate, and that affects the transmission of monetary policy. Here, the plumbing and quantities will matter. And one way you can see this is that you'll get stronger pass-through from the policy rate to the short rate in the corridor system. So that's one illustration for how the plumbing does matter. In the corridor system, a tighter policy corresponds to a bigger tax on liquidity for banks, and that's going to create a stronger pass-through. The nominal assets held by the banks are also going to be important for output and inflation, so how many of these assets are nominal is going to matter. And there's less scope for multiple equilibria in this world, even without the Taylor principle. So the way I'm going to organize the talk is first I'm going to start with transmission in the minimal model that has a disconnect between the policy rate and the short rate that enters the household discount factor. That model doesn't even have banks in it. And then I'm going to introduce banks and show you that the transmission mechanism that I was describing in this minimal model carries over to the model with banks. So let me start with this minimal model. It doesn't have any banks. There is a standard representative household. It has a utility that is separable in labor and a CES aggregate over consumption and money. Sigma is the intertemporal elasticity of substitution for bundles. Eta is the interest elasticity of money demand. For now, I'm going to assume that consumption and money are separable. So utility is separable in consumption and money. That means I'm assuming that eta is equal to sigma. And later, I'm going to consider complementarity, the case where eta, the interest elasticity of money, is smaller than the intertemporal elasticity of substitution. There's a set of standard new Keynesian forms. Consumption goods gets produced as a CS aggregate of intermediates. Intermediate goods are made one for one from labor, and there's Calvo price setting. So there's nothing new here. The government in this minimal model provides digital currency directly to households. So there are no banks. Instead, the government gives reserve accounts to everyone. So this is central bank digital currency. It determines a pass or a feedback rule for the money supply, which I'm going to denote DT, and a pass or a feedback rule for the policy rate ID. So this is the interest rate on this money. And then there's lump sum taxes that are just to satisfy the government budget constraint. Equilibrium requires that there's market clearing in goods, money, and labor markets. And then IS, the interest rate that belongs to the household discount factor, is going to be determined endogenously. The familiar special case of this model is one where the central bank sets a zero interest rate on money and then uses a money growth rule. That's a special case here. Okay, so yes.
The DT is the one that enters the utility function of the household?
Yes, exactly. Yes. So this is money that is directly in this minimal model supplied by the government. And so now we're going to study linear dynamics. We're going to log linearize around a steady state with zero inflation. And that gives us two equations that are very familiar, a standard New Keynesian-Phillips curve and an Euler equation for inflation and output. And the interest rate that enters this Euler equation is IS. That's the interest rate that belongs to the household discount factor. And then households choose money holdings, and they choose money holdings to equalize expected returns on various assets. And so that's the equation that you see here. On the left-hand side, you see deviations of the interest rate that belongs to the household discount factor from its steady-state value. And that's equal to deviations of the policy rate from its steady-state value, plus a term that is the non-financial return on holding money. This is the convenience yield. It's convenient to hold money because it enters your utility function. You find it convenient to hold money, and this term is higher the more you spend relative to how much money you have. So it's the ratio of nominal spending to money that enters here. So this is velocity. So convenience, the convenience yield is increasing in velocity of money. Let me briefly talk about the structure of this difference equation. In the standard model, these difference equations are block recursive. You solve for the price level and output given some policy rate IS. In the model with central bank digital currency, you solve for the price level output and the interest rate that belongs to the household discount factor. Given policy tools, the interest rate on money, ID, and the quantity of money, D. And so here, the price level becomes a state variable, an interesting state variable that has some initial condition. Okay. So how does monetary policy work in the standard model? In a standard model, the Fed just targets the short rate that enters the household discount factor, IS. And then how does monetary policy gets transmitted? Well, if the Fed increases the policy rate, in a world with sticky prices, that increases the real return on savings. And that through an intertemporal substitution mechanism lowers demand, output, and inflation. And so this is how you get real effects in the standard New Keynesian model. And then money is supplied elastically to implement the specific target interest rate that the Fed has in mind. And the interest rate on money is fixed at 0 in the standard model. So how does monetary policy work in the central bank digital currency model, where the Fed gives you a reserve account and then determines the quantity and the interest rate on this reserve account? Yes? Yes, exactly.
It's just a nominal bond
exactly.
yield, but then if you also have it at home, then they send you so much.
Some interest rate, exactly.
That's why it's really the difference. That's the difference when it enters on the money demand equation.
Exactly. So this is basically, you look at this equation is basically a money demand equation, the third equation. And on the right-hand side, you have the interest rate on money. And that's going to be typically lower than the interest rate that enters your stochastic discount factor because you get also convenience from holding money because money enters your utility function. That's the key here. And so what happens if now in this world where you have a reserve account with the Fed, if the Fed changes the policy rate, suppose it increases the policy rate, which is now the interest rate on this account that you have at the Fed, that also increases the real return on savings with sticky prices, and that therefore also lowers output and inflation. But now you have a mechanism kicking in through the convenience yield because lower output and lower inflation means lower nominal spending relative to the amount of money that you have. That decreases the convenience yield, and therefore the overall return on savings that counteracts this increase in the real return on savings that was triggered initially by the policy. The convenience yield moves the other way and therefore dampens the transmission of monetary policy. The money supply here is an independent policy instrument that the Fed can use. So quantities here matter, even in this very simple setup. How does, in this world, how do you get local determinacy? In the standard model, you get many bounded solutions to the difference equation. How do you get these multiple bounded equilibrium paths in the standard model? In the standard model, if households think that demand is lower than in steady state currently, then that means, because it's a demand-driven model, output will be low. That's consistent with having low demand. And through the Phillips curve, farms have low marginal costs, and so then that's generating low inflation. Suppose we have a central bank that uses an interest rate peg. Okay, so suppose the central bank pegs the interest rate. In that case, low inflation means the real rate is high. And therefore, through the Euler equation, through this intertemporal substitution mechanism, that's consistent with having low demand. And so this idea here describes a possible alternative equilibrium path that starts with households thinking that there's low demand, and all the model has these things consistent, hanging together, as long as the central bank uses an interest rate peg. And therefore, using an interest rate peg will lead to multiple bounded equilibrium paths. How can you rule them out in the standard New Keynesian model? One way of doing this is to say, well, use the Taylor principle. In this case, the central bank reacts aggressively to this low inflation and thereby lowers the interest rate. And that's how you counteract the high real rate. And so you rule out this alternative path. Here in the model with central bank digital currency, the convenience yield is going to do something very similar as the Taylor principle does. So how does the convenience yield endogenously rule out this alternative equilibrium path? Well, let's start again with households thinking that demand is low. So output is going to be low. Through the Phillips curve, inflation is going to be low. But now you have low output and low inflation. That means nominal spending is low relative to the amount of money households have. And that means the convenience yield is low. And that counteracts the increase in the real rate. In fact, you get a lower real rate, and that's inconsistent with having low demand. And so here, the endogenous response of the convenience yield rules out these alternative equilibrium paths that can arise in the standard New Keynesian model. So the convenience yield acts like a stabilizing force, and it acts like a stabilizing force just like the Taylor principle does, that counteracts this increase in the real rate. The strength of this effect is going to depend on preferences, technology, and the policy that is going to be used. And so what are the conditions on the model that give you local determinacy? Policy, again, is going to determine the interest rate on your reserve account and the quantity of reserves that the central bank gives. So I'm going to assume either the central bank is using an exogenous path for the interest rate on money or a Taylor rule. And then we'll compare 3 different scenarios for how the central bank determines the quantity of money. The first is the easiest, an exogenous path for the money supply. This is assuming a nominal anchor. Then you always get local determinacy. In this case, the convenience yield strongly responds to inflation. So you get determinacy. An alternative is to assume that the central bank uses an exogenous, or the government is using an exogenous path for real balances. So now you definitely don't have a nominal anchor anymore. So there's an amount of money that is being supplied that is just nominal expenditure, government expenditures. Here you get local determinacy as long as this coefficient on this condition on parameters is satisfied. And if you stare at this condition, you see that there is less scope for multiple equilibria if, for example, money demand is less elastic. If eta is low, then that condition is more likely to hold. That means that the convenience yield responds more to output. Or the New Keynesian Phillips curve is flatter. So for example, if prices are more sticky, you get a lower lambda, then it's more likely that this condition is holding. Or you have a more aggressive inflation response. So if the policy coefficient in front of inflation is higher, then this condition is more likely to be satisfied. So these are the conditions for determinacy if you have an exogenous path for real balances. And alternatively, the central bank can use a rule for the money supply that has nominal rigidities. So dt, the quantity of money today, is some fraction of the quantity of money last period plus nominal government expenditures, some nominal number. Here you get local determinacy if this coefficient mu is sufficiently large. So if there's enough nominal stickiness, you get local determinacy. In other words, if you have enough predetermined nominal money, the convenience yield responds enough. So far, I've assumed that consumption and money were separable. Let's look at you don't need it at all. It helps. So this is the third star. Is it helps if the coefficient on inflation is higher, it helps, but you don't need it. You can live with that, yes, as long as this condition, this is an if and only if condition. So as long as your parameters satisfy that condition, you're safe. And that doesn't involve the Taylor principle. So let's have consumption and money being complements in the utility function. So let's free up the utility function specification. So now I can have non-separable utility, and the empirically relevant case is where the interest elasticity of money demand, eta, is smaller than the intertemporal substitution, sigma. Now, with complementarity, a higher cost of liquidity, so if the difference between the interest rate that enters household Euler or household's discount factor and the interest rate on money, if that difference is high, then you perceive a high cost of shopping. And so households don't like shopping. When the cost of shopping is high, they reduce consumption, they substitute and increase leisure, so they lower their labor supply. Firms have to pay higher wages in this case, and that generates lower output and higher inflation. The question is, how does tighter policies or a higher policy rate affect this cost of liquidity? In the standard model, a higher interest rate that the central bank targets, this is the interest rate in the discount factor of households, with a fixed interest rate on money, increases the cost of liquidity for households directly. In the model with central bank digital currency and the cost channel, then a higher interest rate on money, an imperfect pass-through to the interest rate in the household discount factor is going to lower the liquidity cost. So the policies of raising the policy rate have opposite effects on the cost of liquidity across these two models. And so let me show you how this matters quantitatively. So here we're going to pick some standard numbers, an intertemporal elasticity of 1, a interest elasticity of money demand of 0.2, and standard cost and Calvo parameters. I'm going to assume that the central bank fixes a constant money supply with central bank digital currency. And the Taylor rule has a coefficient of 1.5 on inflation and 0.5 on the past short rate. So there's some interest rate smoothing going on. And so now I'm going to show you impulse responses to a 25 basis point monetary policy shock. So how do they compare? So here's the standard model. So what happens if you increase the policy rate, which is the interest rate in the household discount factor, by 25 basis points? So this is what happens in the lower middle diagram. And so what happens is prices fall. So you have tighter policy, the real rate is higher, prices fall, inflation falls, so you get a recession with deflation. And the money supply reacts endogenously to implement this higher interest rate. So tightening involves reducing the money supply. And what happens to the difference between the policy rate or the short rate and the interest rate on money in the standard model? That increases. So liquidity is getting more costly. Here's what happens in the model with central bank digital currency. So now imagine the Fed increases the interest rate that it pays you on your reserve account by 25 basis points. That increases the policy rate. That also leads to deflation and a recession. But now with a constant money supply, because I've assumed the central bank doesn't change the money supply, what happens to the cost of liquidity? That falls because there's imperfect pass-through from the policy rate, which is the rate that the central bank pays you directly on your account, and the interest rate in your stochastic discount factor. That difference goes down. And so now you see that the price level drops, and then it looks like it's increasing a bit. And in fact, if I show you more quarters, impulse response drawn out with more quarters, you see that the price level eventually goes up again. Because what happens is you've created, with tighter policy, a recession with deflation, lower nominal spending, but you've kept the money supply constant. And that acts like having too much money in the system, and so the price level goes up over time. If you look at numbers, you basically generate about half the output response in the model with central bank digital currency in response to this 25 basis point shock as you would in the standard model. Okay, so now I want to argue that you get the same argument mechanisms that change the transmission mechanism for monetary policy in a model with banks. So far I didn't have any banks. The government gave you the reserve account directly, but now I'm going to introduce banks and they will provide the money to you. So let's start with a system where we have abundant reserves. We are in a floor system. Reserves in this world are going to be special because banks like to hold reserves because they're good collateral to back deposits, but they're not special because they provide liquidity services. There's so many reserves here that banks have plenty of liquidity, so they're not needed for liquidity. And so in this world, the policy rate is going to be the interest rate on reserves. So what are banks? Banks have a balance sheet where they hold reserves. They hold some other assets A. They have some money D. That's what they issue to you. And they maximize shareholder value. What's the shareholder value? There's some cash flow every period. And these are just changes in these positions that are on the balance sheet of the bank. It's basically the bank comes in, it gets some interest on its reserves, it holds some new reserves, it has to pay interest on deposits, it receives some new deposits, and it gets some interest on the other asset it holds and chooses to hold some new assets. And so banks will maximize the shareholder value, this discounted shareholder value into the future, and they can costlessly adjust equity. In a world where households derive utility from deposits, issuing deposits for banks is going to be very cheap because banks get away with paying you low interest on deposits. And so therefore, if you have a shareholder maximization problem and no other frictions, banks would go 100% deposit financed. So you need to constrain their leverage. So you need some friction to prevent that from happening. And so here we're going to use the leverage constraints. Banks can't issue more deposits than some fraction of risk-weighted assets. So rho here is a risk weight. Imagine this is lower than 1 because other assets are not as good collateral as reserves. Reserves are the best form of collateral that banks could have. Banks have to deliver an interest rate or a rate of return to households. Households are their shareholders, and so that's IS. And banks will then choose all the entries on their balance sheet to equate the returns on assets and liabilities to this cost of capital. I'm going to say the Lagrange multiplier on this leverage constraint is gamma t. And then I can look at the bank's first order conditions, and they're going to take the following form. So they know they have to deliver a return on equity, IS, and that's going to be by choosing how many reserves and other assets to hold. They're going to use satisfy these first order conditions, where gamma t is the Lagrange multiplier on the leverage constraint. So here this basically says banks will choose reserves so that to equalize the return on equity with a financial return on reserves, plus the collateral benefit that they get from holding reserves. And that's expressed by this Lagrange multiplier on their leverage constraint. They also get a collateral benefit from holding other assets, but they get less collateral benefit because this rho, this risk weight on the other assets is less than 1. So you immediately see that there's this collateral benefit on the other asset is lower. And so then creating money for banks is going to involve leverage costs. And so they will create money to satisfy this first order condition. They're going to pay you an interest rate on your deposits that satisfies this equation because the second term here is the leverage cost that they incur when they issue money. And so then I can combine the first equation and the third equation and show you how costs of liquidity for banks get passed on to the consumer through this equation using the coefficient 1 over L. L is some fraction, is the leverage constraint that says banks can only lever up to a fraction of assets. L is this fraction. So the cost of liquidity for consumers is going to move more than the cost of liquidity for banks. I can extend this to market power, but will not because Chris won't give me the time. And so here, what's in equilibrium here? The government here runs a floor system with abundant reserves. It chooses a path or a rule for the quantity of reserves, a path or a rule for the interest rate on reserves, and then you have market clearing for reserves and other bank assets. So there's some path or a rule for the exogenous here. We're going to take the supply of nominal assets to be exogenous. That stands in for borrowing by farms or borrowing against housing. And this nominal rigidity, that could be due, for example, because we have long-term contracts when farms and households borrow against housing. When we characterize the equilibrium, the new Keynesian-Phillips curve and the Euler equation are unchanged. What does change is this equation that links the policy rate to the interest rate in the household discount factor. And so in fact, you see that the pass-through from the reserve rate to the interest rate in the household discount factor involves a term that looks exactly like the one that we had before in the central bank digital currency model. There's a convenience yield. And so here in this model, reserves that back inside money inherit the convenience yield that deposits have. The money supply, the leverage constraint is going to bind, so I can write the money supply in this form. Deviations of inside money from its steady state value are being driven by deviations of reserves and other assets from their steady state value. And so you see that reserves here are a separate policy instrument. By increasing reserves, that's stimulating because it's increasing the amount of inside money. And other bank assets also matter. So for example, if you have a bad loan shock because you're experiencing a financial crisis, that's contractionary. So it works exactly like the central bank digital currency model, just like the coefficients in this world, for example, supply of inside money, are going to depend on the banking system. What changes when you have scarce reserves? You have an additional consideration because now reserves are also interesting to manage liquidity. So you imagine a world in which banks are being hit by liquidity shocks. They have to pay deposits to each other. And so that's when reserves become interesting. So there's some distribution for these reserve shocks, but everything else is going to be, so there's going to be an interbank market that opens where banks can borrow and lend these reserves to each other. In this world, the government fixes a path or rules for the Fed funds rate, fixes an interest rate on its reserves, and lets the reserve supply adjust endogenously to implement the interest rate on the Fed funds rate. Let me just show you the key equation here is that, again, you have a pass-through from the Fed funds rate to the interest rate in the household discount factor involving a term that looks like a convenience yield. And you have an equation for the quantity of inside money that now is more income and interest elastic. So there are terms on the right-hand side of this equation that now involve income and interest rate. So the inside money supply in this world with scarce reserve is more elastic. And so if you look at impulse responses, if you compare the impulse response in the floor system, that's the green line, with the impulse responses in the corridor system in the blue line, to the same 25 basis point policy shock, you see that they're different. In particular, the floor system has, in the corridor system, you have stronger effects of monetary policy. So the blue line reacts more in response to a 25 basis point tightening than the green line. And that's because in the world with scarce reserve, in the upright diagram, the inside money supply adjusts endogenously. And while in the floor system, there's no adjustment in the quantity of money. And so let me reiterate the message of the model that you saw. There's a disconnect here between the policy and the short rate. And the disconnect is being driven by the convenience yield, which generates an endogenous wedge. And that matters for policy. Thank you.
I don't know how familiar you all are with this stuff. Larry knows it for sure. He knows what an NK model is. How much they teach it around here, I don't know. I don't teach it. So the basic thing is it's got a lot of Minnesota in it. So the basically neoclassical growth model. It's like you took Gary Hansen, you took out the indivisibilities and then added some stuff. So there's Dixit-Stiglitz monopolistic competition. Kind of looks like this chapter in Cooley's book, Woodford and Rottenberg, kind of builds on that. So you got that. Now you've got prices denominated in some stuffed, and the stuff it's not held in equilibrium. You got a Calvo pricing technology, and that's in terms of the prices denominated in this stuff, and then monetary policies kind of dictating a price of a bond that pays off in units of stuff next period. So it's kind of like, the problem is, it's more like a public finance problem. So you kind of got this coarse instrument for correcting things that look like tax wedges. You can price a lot of assets in these models, just like in any kind of standard representative agent, complete markets framework. Assets really don't have anything, throwing in an asset really doesn't have anything to do with the equilibrium allocation, but you can determine prices. Okay, what's central banking about? So typically, our modern central banks have a monopoly on the supply of the old-fashioned physical currency. There's some daylight interbank payments going on, which generally is something central bank participates in. The interbank payments are done on the banks of the central bank using what we think of as reserve accounts. Central bank lending, that's important. Sometimes that's part of the normal operating procedure of the central bank. ECB, that's the way they work. They don't have like daily intervention. They got this kind of central bank lending to financial institutions in the euro area. Then there's this lender of last resort role for the central banks. Got something to do with idiosyncratic things going on at the individual financial institution, or in things that happen in the aggregate, like in the financial crisis. Central bank's restricted in what it can do, so it's restricted. Different rules in different places, but basically the lending is secured lending. There's lists of eligible collateral that they worry about, and haircuts and whatnot. Asset swaps. Central bank can do various kinds of asset swaps. There may be rules about what kinds of assets you can buy. Operating procedure. So 2 kinds of those things, but there could be more. There's lots of ways you can do operating procedure. This is just how you got a target for some overnight interest rate. How do you hit this target? So there's a corridor or channel system. So I'll show you later. Hopefully I have time to show you one in operation where an overnight rate gets pegged through daily intervention, typically in a repo market. There's a floor system like what you have in the U.S. currently, with a large stock of reserves outstanding. Then there's kind of this important interaction with the financial intermediary sector. That's going to matter for this paper in particular. There's banks, but there's a whole load of other financial institutions that are important too, that are going to be kind of on the receiving end of what the central bank is up to. Okay, so I talked about this baseline NK model. Here's a central bank. Well, what's the one got to do with the other? Well, the baseline thing, I think, not much. So the puzzle is, why do, I don't know if I even answered this question. So I was kind of starting to tear my hair out while I was thinking about this slide. So I asked the question. I know, I think I know what the answer is, but anyway, so I gotta say, seemingly, the baseline models, baseline NK models, don't have all the detail that allow you to answer questions you might want to answer about monetary policy. There are kind of no assets in these models that matter. You don't see a central bank balance sheet. There's no financial intermediaries that matter in an important way. There's no physical currency, other means of payment, or how you'd think about substitution among means of payment or something. What questions do we want to answer? Well, just basic things like what's an open market operation do? Is it going to make a difference whether a central bank swaps reserves for long maturity assets or short maturity ones? How do you operate this? How do you manage this operating system efficiently? How do you do central bank lending in a crisis? Do you even want to do that? Some people have argued about, would open market operations in a crisis work better than, or some other type of intervention work better than targeted lending or something? we've got kind of advances in technology, technology of payments. Should central banks be getting into the business of issuing other kinds of liabilities than just this old physical currency, et cetera? Whole lot of questions we'd like to answer. Okay, so this paper. So here's what's done. So the authors understand I think the deficiencies in baseline NK models. They're going to build on it by adding some role for assets and banking arrangement. And then part of the motivation is kind of Monika's does a lot of work in asset pricing, so she understands kind of how the models baseline models don't fit the data, that they're something you might call a convenience yield associated with short bonds, and that maybe quantities of assets outstanding matter more for pricing than you might think, given basic asset pricing models. Okay, so the models Monika talked about, there are two. So let's see, the first one basically got like a two asset model. So there's something I think of as a nominal bond, goes in the utility function, and then another nominal bond that thing's not in the utility function. That's the usual thing we think about that's tied to the intertemporal marginal rate of substitution, and the oh, geez, I got 5 minutes. Okay, so then the second one's got this banking in it with abundant reserves and scarce reserves. So then the questions kind of have to do with determinacy and interest rate pass-through. So comments. So what they're doing is important here. It's important questions and interesting problems and taking a step in the right direction. And then my problems are going to have to do with, well, you could go further, I think, and have to do with the details here. Assets in the utility function. So I think Neil Wallace kind of told us why that was a bad idea. There's a parameter in there, the degree of complementarity between money and consumption. That's not some structural parameter. I don't know how to even think about that. I got a bunch of complaints. Where's the currency? That's an issue. Maybe old-fashioned stuff, but in kind of normal times where you don't have a large central bank balance sheet, the physical currency outstandings financing the whole central bank portfolio. You want to think about what the currency does. Are we interested in this idea of the pass-through? So I wasn't sure about that one. What exactly are we interested in moving around exactly, and why? So I got various stuff I wrote down about this. Local determinacy. So a lot of here's what we know. So the cases where you can write down models that'll tell you what the global dynamics are. The Taylor rule in particular gives you like it's poorly behaved in a global sense, in a wide class of standard models. So I'm not sure the local determinacy tells you much about what you want to know. I'm going to keep. Hopefully I'm being constructive here, but I think it kind of sounds like complaining. Anyway, so so some things that, there's a question of whether you're thinking about things that have to do with kind of like fiscal policy or monetary policy. So again, I won't go into the details. So I want to tell you a little bit about, I'll show you some charts. So this has to do with what's going on in the paper to do with cases you think of like scarce reserves and abundant reserves. This is Canada, so this is showing you just like reserve balances. So the the case, so there's a period in like about a year, 2009 to 2010, which you'd think of as abundant reserves, but it's not very much. This is like $3 billion in Canada. So multiply by 10, maybe get corresponding like 30 billion US or something. Before the financial crisis, outstanding reserves in the US are about 50 billion. So that's a small number, but that's what it takes to run a floor system in Canada. Small amount of reserves. And then you see other times, there's kind of a little bit of slippage. There's a bit of friction in there, but the other times outside of 2009 to 2010, that's a world that I think of as like, it's roughly zero. It's like millions of dollars in some cases, and it's a small amount of reserves in the system that's in there. It's in there overnight just due to like timing frictions in the overnight market. So the point there is that, it doesn't take. And I don't think it would take a lot of reserves in the U.S. even to run this floor system, but the Fed seems to think they need a whole lot, over $1 trillion to run a floor system, which I think is nonsense. Somebody should be talking about that. So this is the corridor in Canada. So 3 rates: the repo rate, which is in the middle, and two rates that bound that, and then you see that short period of a year in 2009 to early 2010, where they're in this floor system, and then the interest rate on reserves pegs the overnight rate. Okay, so here's, this is a picture of the big balance sheet. I don't want to say about that. There's stuff going on. I'm out of time. I won't talk about that. But then there's these anomalies in interest rate data. This is like the low one here is the 1-month T-bill rate. The middle one is the Fed funds rate. The top one is the interest rate on reserves. So that's not a floor system working very well. That's 2016 for the year when not much was happening on the policy front. Here's later on. So what you have happening here, you can see like you get on towards, the thing starts to work back here, like 2000, I don't know, kind of, 2018 or so. It's, now what changed here was that the Fed stopped buying assets. They phased out their asset purchase program, and then the rates start to converge, but then something starts getting screwed up again out here, where the top one's the repo rate. The spikes that you get at the end of month, they start going in the other direction and stuff. And now the Fed funds rate, that's above the interest rate on reserves. Things changed entirely. So I think that has something to do with Fed intervention and collateral in the markets. Basically, they're taking out reserves, which I think putting in reserves, which I think is bad collateral in exchange for good collateral, which is the treasuries. That's messing up the overnight market. That's my notion anyway. So that's just some stuff. Anyway, so I gotta quit. Thank you.
Well, we're over, but are there any questions for Monika? Well, I'll let Monika.
Would you take the typical New Keynesian model and you take an allocation that's implementable as equilibrium? There's always like a short rate that implements that allocation as equilibrium. Now, if I translate that to your model, is it that there's always, because now we have this disconnect between the short rate and the policy rate, is there always a policy rate that implements that short rate, that implements that equilibrium allocation, or is it that as soon as you try to target that particular short rate, you're also changing equilibrium, so you're actually changing the set of implementable allocations?
So you can. Yeah. So the point is here is that in in the New Keynesian model, so let me also first thank Steve. That was very useful. Related to this question, why do we care about pass-through? Is because what matters for allocations is this IS, this interest rate and the stochastic discount factor that shapes all these intertemporal decisions. Okay, and in the New Keynesian model, the policy rule basically sets this IS, and then that's where the allocations follow from. Okay, now here, you can always use the tools of the central bank that includes the supply of reserves and the policy rate in order to get ISs that you want. Okay, but if you just, so our main point is that if you just put a Taylor rule for the policy rate, that is not sufficient. Because that will not generate the ISs that you would get from a Taylor rule in the standard model. Okay, and so we don't want to think, especially in this floor system, there is this quantity of money, or perhaps including T-bills. I mean, we agree that in a floor system, then bonds overall is what matters. That is important for the allocation.